Well, dividend investing is not dead. It's evolving, and ETFs are leading the charge. So do you want consistent dividend growth, or do you want high yield? What are you seeking? Maybe you want to have a lower yield with potential higher capital growth down the line. Well, today's audience requested ETF Battles is a heavyweight bout between dividend ETFs from Fidelity and Blackrock. It's DGRO versus FDVV. Which is the better choice? Stick around. This is ETF Battles. I'm Ron DeLegge, and this is the place that we gather together to analyze and judge ETFs. Send me your ETF matchup request in the comment section below. Be sure to include your ETF ticker symbols. We could do double, triple, and quadruple headers. And for those of you that are first-time viewers, hit the subscribe button to join our community. Also, don't forget to hit the description section below. We've got our program sponsor Direction located there. Be sure to visit direction.com. So today's audience requested matchup was from Michael Kapler. This is a viewer who requested FDVV from Fidelity Investments versus DGRO from Blackrock. And this is a heavyweight bout between two dividend-focused ETFs. So which is the better choice? Well, judging today's contest, we got a duo extraordinaire, John Davi with Astoria Portfolio Advisors and Athanasios with Bloomberg. Guys, welcome back. Great to have you.
Hey guys, nice to see you.
Good to see you guys.
So we got our four battle categories: exposure, cost. We've got, cost, exposure, strategy, performance, and yield are combined, and then mystery. Going to give each of you an opportunity to weigh in with your analysis. At the end of the program, we will declare an overall winner. Keep in mind that none of the battle outcomes we do on this program are ever known in advance by myself or our judges. So the first category is cost. John, please get us started.
Sure. So, DGRO is 8 basis points. The Fidelity product, 16 basis points. So DGRO is cheaper. If you're sort of a buy and hold, you're not going to trade in and out. DGRO is an interesting product for sure. But, I think everyone should think about, total return. They should think about trade and liquidity. I'm sure Athan is going to talk about, trade and liquidity. But, when you start kind of comparing actually how these things return and how they perform, it's a very different story. But just purely on management fees, DGRO is a winner by 8 basis points.
Athan, you're up next. How do you see it when it comes to cost?
Yeah, all good points. And I know what the performance is already, right? But obviously, just by choosing something necessarily because it's cheaper headline doesn't always mean it's better performer. But to John's point, if these are long-term plays with sure dividends, which a lot of times there are, you want to try to minimize cost as possible. 8 basis points for the DGRO product. It's massive. It's $33 billion versus $5 billion for the Fidelity product. They're all U.S. stocks. They both trade really well. I just think it's half the price of the Fidelity one. So I think just from a headline perspective, you gotta have to give this one to DGRO.
All right, let's get into exposure strategy and compare these two ETFs versus each other. Athan, you're still up, so break it down for us.
Sure. So they're both dividend focused, but they're a little bit different. The Fidelity one is called the high dividend ETF. So as you can imagine, it's going after, it's looking at yield, companies that have the highest yield. It's also got another factor in there like payout ratio, like how much is there potential for them to keep raising the dividend, and dividend growth, versus DGRO, which is just more stable companies that have consistently raised their dividends. So Fidelity one is also very concentrated. It's only 100 names. You get almost 400 in the DGRO products. So it's a little bit more watered down. Just bear with this. You're going to have some different sector tilts. So with the Fidelity product, you tend to be a little bit overweight tech than the DGRO product. You're a little overweight financials. So just be wary of like kind of the different sector weights that you'll have. This is a tough one. I don't know if one's necessarily better. I think if you want something that's more kind of stable and quality, the DGRO one, lean towards that one. If you want something that just has highest yield or has the potential to keep raising, have FDVV. I think I'm pretty split on this one. I think they're both really unique methodologies. I don't know if one is necessarily that much better. So I think I'm going to do a split decision on this one.
Thank you, Athan. John, you're up next. Exposure strategy. How do you see it?
Well, I'm going to do my usual screen sharing. Just give me a moment here. I know you like when I share my screen.
I love it. You always shock me with new and surprising things.
All right. So I think it's so it's nice to talk about dividends, something that's, sort of like, people like Warren Buffett have been doing for, decades and decades and decades. Cause, I feel like everyone, all they want to do is talk about, AI and sort of Bitcoin and, growth, right? But, in your portfolio, when you construct a portfolio, you should have diversification, right? That's sort of what we preach to our financial advisors. So, a lot of the core of your portfolio could be in, something that looks like low cost index beta. But, if you think about your traditional 60-40, you shouldn't put, all 60% in low cost beta. You should have diversified factors, diversified sectors. So, dividends, which have been largely ignored, the last 2-3 years as we've had this, epic AI induced rally. But you really want to load up these two ETFs into a portfolio construction tool. You could use Bloomberg Port, Tom Athan's firm, or something like a Vanguard, which is free for advisors. So when you load it up, you kind of see like how these things shape up. From like a style box standpoint, valuation standpoint. We principally at Astoria, we're a high conviction asset manager. We don't like using, we like more concentrated portfolios. So FDVV sort of fits our style box, right? 100 securities. The ETFs that we manage, PPI, for instance, has like 60 securities. ROE has like 100. So I don't like buying like big blocks, sort of like DGRO, which has, 398 securities. What Tom also was alerting to, I think makes a lot of sense, right? Where do you want to be in terms of like, sectors, right? So we like tech. We like tech a lot. So, FDVV, has more tech exposure, which I think is very interesting. So, I do like FDVV. We'll talk about performance in a second, which is, not even like, FDVV sort of blows out DGRO out of the water. So I'm going to be sort of partial to FDVV in this conversation. So purely from like a exposure standpoint, I like what FDVV is doing. So I'm going to give that as a category winner.
Got you down. That takes us next to performance and yield. And you're still up, John. So I don't want to steal your thunder. You kind of alluded to it, but break it down for us. How do these ETFs look in terms of performance and yield?
Yeah, so, whether it's 3 months, year to date, 1 year, 3 year, 5 year, it's substantial outperformance. On a year-to-date basis, it's about 250 basis points. On a 1 year basis, it's 400 basis points. This is FDVV outperforming DGRO. On a 3 year basis, it's like 17%. So it's just clearing away. Even on a 5 year basis, it's like 40%. So clearly, there's like an alpha signal that Fidelity has uncovered. And, I wouldn't necessarily say like, one's doing one thing and one's giving high dividend yield in stocks, concentrated, making a lot of idiosyncratic stock specific bets. DGRO is, doing something different. It's dividend growers, right? So it's companies that have like steadily increased their dividend. So anyway, FDVV is a battle category winner across a number of like trailing periods.
Got you down. Athan, you're up next. How do you see it in terms of performance and yield?
Yeah, I agree. I think it's not even close. FDVV has higher yield because it's a high dividend ETF and it's got better performance. And again, a lot of it is tech bet, right? It's got a bunch of semiconductors in there. In hindsight, that's helped a lot. The concentrated nature of it has helped a lot. So it's not even close, I think, when you sort of look at it through any metric for a dividend fund. FDVV is the winner here.
All right, that takes us next to our mystery category. This is where our judges can give us a factor or thing that's crucial to this contest. Athan, what's your mystery battle category? Which of these two ETFs wins it?
So one thing that we always like to look at is sort of concentration and how complementary is it to like something like SPY. So you just have to assume a lot of people hold SPY already, right? So it depends on how you want to use this in your portfolio. Like if you want this to be your core holding and replace SPY, just because of the bigger tech weight in FDVV, that one make more sense. But if you're using it as a complement, if you're maybe afraid that you have too much tech exposure, yeah, you're getting it in DGRO, but you have a much more diversified play there to counter the S&P. So I think concentration is something to just keep aware of. Again, it's helped FDVV. I like it. Again, it depends what you're using it, but I think as a core, DGRO makes a little bit more sense, a little bit more, it's a little bit more stable, it's a little bit more diversified. Again, it all depends how you think we are in this cycle. Do you want to load up more on tech? But I just think as a core, DGRO offers a nice diversified basket compared to the other ones. So sort of concentration, diversification, I'll give it to DGRO.
John, you're up next. What's your mystery battle category, and which of these two ETFs wins it?
When we, as an asset manager, we pick ETFs, we build, portfolios for advisors. A lot of times, like when we figure out where we are in the market cycle and we determine our tilt where we want to be, and we have a choice of ETFs, we put it through like this, let's say 4-factor model, which is, combination of like P ratios, growth estimates, estimate revisions, earnings momentum. So, I was sort of taught in the late 90s when I was in quant research at Merrill Lynch that you want to buy, an asset class, a stock, a sector that has, low valuation. So let's just use P ratio as a valuation metrics, where there's high growth estimates, there's, strong estimate revisions, and there's solid earnings momentum. So, you want this sort of matrix of like, cheap P ratios, good growth, good estimate revisions, good momentum on the earnings front. And, Fidelity does check that box, right? And I just put in some of these other dividend ETFs here for comparison. And then like, SPY as just your anchor to compare it to. So, some of these other dividend ETFs, you'll see they have higher valuations, or they're not as strong estimate revisions, or the growth estimates are lower. So I think there's definitely like an alpha signal that Fidelity has uncovered. And so that it wins on a number of different, multi-factor valuation framework that we use when we screen our ETFs.
Okay, so now we move to the part of the program where our judges can give us their overall winner. John, your final chance to weigh in.
Well, FDVV has, good performance. It's got good valuation metrics. It's got a highly concentrated portfolio. We are a high conviction, asset manager. And when we pick ETFs to outperform our benchmark, we want ETFs that have like high conviction themselves. And FDV certainly does. DGRO is a good product. There is an audience that uses low cost, broad exposure building blocks like DGRO, but for what we do, for how we manage money, I'd give it to the Fidelity product.
Athan, your final chance to weigh in with your overall winner.
Yeah, it's tough. Like John said, they're both good products. DGRO is great too. I think it depends how you want to use it. Again, as I was alluding to before, core versus like a satellite. But it's really hard to argue with FDVV. Like even the yields are not that far apart. It's like 3% for the Fidelity product, 2% for the Blackrock one. But the performance you're getting is so much different, right? And it's really hard to argue against that. And they're more of an AI bet, which is working. And so I think just overall the Fidelity product is a little bit different. And again, the concentration helps. So really close, both great products. I think if you're looking for dividends, you'll be okay with either one of them. But I'll give this one to the Fidelity product.
All right. Well, our judges have spoken, and according to my final battle scorecard, today's winner is going to be FDVV from Fidelity. And our judges agreed on most points. And FDVV, as pointed out, if you're seeking higher current income, that's the choice. Also, if you're more comfortable with a more concentrated portfolio of large cap value stocks, that's what you're getting with FDVV, especially concentrated to the tech sector. And also, as pointed out, DGRO, better suited maybe for investors who are prioritizing long-term dividend growth with maybe some broader diversification and lower fees. So a lot really depends on the portfolio application, but our judges did a great job in breaking it down for us. Well done, John and Athan. We appreciate you making the time here on ETF Battles.
Thanks for having us.
Yeah, thanks for having me on.
Hit us up in the comment section below with your ETF battle requests. And that does it for today's episode of ETF Battles. Thanks for watching. Be sure to subscribe and tell your 10 million friends. We'll see you on the next episode.